we hold a regular press conference, but now due to the need for social distancing and the precautionary steps which we are required to take, all of us, I decided to address the media. And since there is no press conference, I have tried to make my statement as explanatory as possible, as self-explanatory as possible, so that the room for questions, etc., are minimized considerably. So therefore, the statement is a bit long. I request your patience, and I would also request you to please be patient till the end, because towards the concluding paragraphs, I have tried to give some forward guidance. In view of the COVID-19 pandemic, the Monetary Policy Committee decided to advance its meeting, which was originally scheduled on 31st March and 3rd April, and the announcement was due to be made on 3rd April. We decided to announce it to 24th, 26th and 27th. Accordingly, the MPC met on 24th, 26th and 27th March and undertook a careful evaluation of the current and evolving macroeconomic and financial conditions, and of course the outlook. I wish to take this opportunity to express my sincere thanks to the MPC members for responding so quickly. I also wish to place on record my appreciation of all the staff and officers of RBI for their excellent cooperation in facilitating this. After extensive discussions, the MPC voted for a sizable reduction in the policy repo rate and for maintaining the accommodative stance of monetary policy as long as necessary to revive growth, mitigate the impact of COVID-19 while ensuring that inflation remains within the target. While there were some differences in the quantum of reduction, the MPC voted by a 4-2 majority, that is by a 4:2 majority, to reduce the policy repo rate by 75 basis points to 4.4%. I repeat, the rate cut decision is 75 basis points, and accordingly the repo rate stands reduced from 5.15% to 4.4%. Simultaneously, the fixed rate reverse repo rate, which sets the floor of the liquidity adjustment facility, that is the LAF corridor, was reduced by 90 basis points. I repeat, 90 basis points to 4%, thus creating an asymmetrical corridor. The purpose of this measure relating to reverse repo is to make it relatively unattractive for banks to passively deposit funds with the Reserve Bank, and instead to use these funds for on-lending to the productive sectors of the economy. It may be recalled that during the month of March so far, the banks have been parking close to rupees 3 lakh crore on a daily average basis under the reverse repo, even as the growth of bank credit has been steadily slowing down. This decision and the advancement of the MPC has been warranted by the disruptive force of the coronavirus. It is intended to, 1, mitigate the negative effects of the virus, 2, to revive growth, and above all, number 3, to preserve financial stability. We are living through an extraordinary and unprecedented situation. Everything hinges on the depth of the COVID-19 outbreak, its spread and its duration. Clearly, a war effort has to be mounted and is being mounted to combat the virus, involving both conventional and unconventional measures in a continuously battle-ready mode. Life in the time of COVID-19 has been one of unprecedented loss and isolation. Yet, it is worthwhile to remember that tough times never last. Only tough people and tough institutions do. In the recent period, Reserve Bank has been in action on a daily basis with efforts to alleviate financial stress, build confidence and keep the financial system sound and functioning. And we have taken a number of steps over the last 1 month or so since the conclusion of the last MPC meeting In my statement, I have listed out the measures which have been taken. For the sake of time, I am not reading it out. Once the statement is uploaded, I think those who are interested can have a look at it. Let me assure that the Reserve Bank is at work and in mission mode, monitoring the evolving financial market and macroeconomic conditions and calibrating its operations to meet any need for additional liquidity support as well as to undertake other measures as may be warranted. It is our effort to ensure normal functioning of the markets, nurture the impulses of growth and preserve, I repeat, and preserve financial stability. Incidentally, we have in RBI quarantined 150 members of our staff and service providers together with the IT facilitators and the entire IT facility as a part of our business continuity plan. The plan was prepared and executed in a matter of days. The MPC noted that global economic activity has come to a near standstill as COVID-19 related lockdowns and social distancing are imposed across a widening swath of affected countries. Expectations of a shallow recovery in 2020 from 2019's decade low in global growth have been dashed. The outlook is now heavily contingent upon the intensity, spread and duration of the pandemic. There is a rising probability that large parts of the global economy will slip into recession. Turning to growth in India, the implied GDP growth of 4.7% in Q4 of 1920 in the second advance estimates of the National Statistics Office, which was released in February 2020, within the annual estimate of 5% for the year as a whole, is now at risk. As regards the outlook for 2021, apart from continuing resilience of agriculture and allied activities, most other sectors of the economy will be adversely impacted by the pandemic, depending upon, I repeat, its intensity, spread and duration. We have to recognize that the government has taken timely and appropriate measures to contain these three factors, that is to contain intensity, spread and duration. And let us all cooperate with the measures announced by the government to deal with the problem, to prevent the spread of coronavirus, to contain it and win this war. If COVID-19 is prolonged and supply chain disruptions get accentuated, now these are risk factors which I am listing out. It all depends how we respond to the situation. I am just listing out the risk factors. Only time will tell how effectively we have acted as a nation and how effectively we have been able to contain the spread of coronavirus and how effectively we have been able to restrict its adverse impact on our growth. So if COVID-19 is prolonged and the supply chain disruptions get accentuated, the global slowdown could deepen with adverse implications for India. The slump in international crude prices could, however, provide some relief in the form of terms of trade gains. Downside risks to growth arise from the spread of COVID-19 and prolonged lockdowns. Upside growth impulses are expected to emanate from monetary, fiscal and other policy measures and the early containment of COVID-19. As regards inflation, the prints of January and February 2020 indicate that actual outcomes for the quarter are running 30 basis points above our earlier projections, reflecting the onion price shock. Looking ahead, food prices may soften even further under the beneficial effects of the record food grain and horticulture production, at least till the onset of the usual summer uptick. Furthermore, the collapse in the crude prices could work towards easing both fuel and core inflation pressures depending on the level of pass-through to the retail prices. As a consequence of COVID-19, aggregate demand may weaken and ease core inflation further. Heightened volatility in financial markets could also have a bearing on inflation. Given this heightened volatility, unprecedented uncertainty and extremely fluid state of affairs, projections of growth and inflation would be heavily contingent on as I earlier said, the intensity, spread and duration of COVID-19. Precisely for these reasons, the MPC decided to refrain from giving out specific growth and inflation numbers because the situation is fast changing and the outlook is extremely uncertain. In fact, this kind of uncertain outlook has never been seen before. And as I mentioned earlier, I would again like to repeat that if we, all of us, every citizen, every person who lives in this country, if we follow the rules, if we follow the advices given by the government and other authorities, then as a country we should be able to win this war against COVID-19, in which case much of the worries that we have in our growth outlook would get considerably reduced. The MPC noted that macroeconomic risks both on the demand and supply side brought on by the pandemic could be severe. The need of the hour is to do whatever is necessary to shield the domestic economy from the pandemic. The Government of India has yesterday announced a number of measures which are expected to provide relief to various disadvantaged sections of the society. The MPC further noted that the Reserve Bank has taken several measures to inject substantial liquidity in the system. Nonetheless, the priority is to undertake strong and purposeful action in order to minimize the adverse macroeconomic impact of the pandemic. It also underscored the need for all stakeholders to fight against the pandemic. Banks and other financial institutions should do all that they can to keep the credit flowing to the economic agents which are facing financial stress on account of the isolation that the virus has imposed. Market participants should work with regulators like the Reserve Bank and the SEBI to ensure the orderly functioning of markets in their role of price discovery and financial intermediation. Strong fiscal measures are of course critical to deal with the situation. To summarize, COVID-19 stalks the global economy and the outlook is highly uncertain and of course negative. Several nations are battling its exponential contagion. Countries are shutting down to prevent being sucked into a kind of black hole. Authorities all over the world are mobilizing on a massive scale to fight an invisible assassin. India has locked down economic activity and financial markets are under severe stress. Finance is the lifeline of the economy. Keeping it flowing is the paramount objective of the Reserve Bank of India at this point of time. The time has therefore now come for the Reserve Bank to unleash an array of instruments from its arsenal to staunch and mitigate the impact of COVID-19, revive growth and above all preserve financial stability. The aggregate action and stance of MPC provides a befitting launching pad. In turn, the configuration of initiatives unveiled in the statement on development and regulatory policies, which I am now going to spell out, amplify the MPC's decision and leverages on it as well. Accordingly, it is appropriate that the MPC's decision and the other actions which I am now going to elaborate upon should be regarded as a comprehensive package with force multipliers. The developmental and regulatory policies can broadly be delineated under 4 categories. First, measures to expand liquidity in the system sizably to ensure that financial markets and institutions are able to function normally in the face of COVID-related dislocations. 2, steps to reinforce monetary transmission so that bank credit flows on easier terms are sustained to all those who have been affected by the pandemic. 3, efforts to ease financial stress caused by COVID-19 disruptions by relaxing repayment pressures and improving access to working capital. And 4, endeavor to improve the functioning of markets in view of the high volatility experienced with the onset and spread of the pandemic. I would announce them in broadly 3 sections. The first section relates to liquidity measures. A multi-pronged approach comprising both targeted and system-wide liquidity provision has been adopted to ensure that COVID-related liquidity constraints are eased. The first announcement relates to targeted long-term repo operations, TLTRO. Let me elaborate further. Large sell-offs in the domestic equity, bond and forex markets have intensified redemption pressures. Liquidity premia on instruments such as corporate bonds, commercial papers and non-convertible and debentures have surged. Financial conditions for these instruments, which are used inter alia to access working capital in the face of the slowdown in bank credit, have also tightened. To mitigate the adverse effects on the economic activity leading to pressures on cash flows across sectors, the Reserve Bank will conduct auctions of targeted long-term repos of up to 3-year tenor of appropriate sizes for a total amount up to rupees 1 lakh crore at a floating rate linked to policy repo rate. Liquidity availed under the scheme by the banks has to be deployed in investment-grade corporate bonds, commercial paper and non-convertible debentures over and above the outstanding level of their investments in these bonds as on March 25, 2020. Eligible instruments comprise both primary market issuance as well as secondary market purchases, including from mutual funds and non-banking finance companies. Investments made by the banks under this facility will be classified as held to maturity, HTM, even in excess of 25% of the total investment permitted to be included in HTM portfolio. Exposures under this facility will also not be reckoned under the large exposure framework. The first auction of rupees 25,000 crores under this arrangement will be conducted later today. The relevant notification in this regard is being issued separately. The second announcement under the liquidity measures includes cash reserve ratio, CRR. It is observed that despite ample liquidity in the system, its distribution is highly asymmetrical across the financial system and starkly so within the banking system. To help banks tide over the disruption caused by COVID-19, it has been decided to reduce the cash reserve ratio, CRR, of all banks by 100 basis points to 3% of net demand and time liabilities, that is NDTL, with effect from the reporting fortnight beginning March 28th for a period of 1 year. This reduction in CRR would release primary liquidity of about rupees 1,37,000 crores uniformly across the banking system in proportion to liabilities of the constituents rather than in relation to their holding of excess SLR. Furthermore, taking cognizance of hardships faced by the banks in terms of social distancing of staff and consequent strains on reporting requirements, it has been decided to reduce the requirement of minimum daily CRR balance maintenance from 90% to 80% effective from the first day of the reporting fortnight beginning March 28, 2020. This is a one-time dispensation available up to June 26, 2020. The next announcement relates to marginal standing facility. In view of the exceptionally high volatility in domestic financial markets, which brings in phases of liquidity stress, and also to provide comfort to the banking system, it has been decided to increase the accommodation under the marginal standing facility, MSF, from 2% of the statutory liquidity ratio, SLR, to 3% with immediate effect. This measure will be applicable up to June 30th, 2020. This measure should provide comfort to the banking system by allowing it to avail an additional rupees 1.37 lakh crore, that is 1,37,000 crore of liquidity under the LAF window in times of stress at the reduced MSF rate announced in the MPC's resolution. These three liquidity measures relating to TLTRO, CRR and MSF will inject a total liquidity of 3,74,000 crore to the system, 3.74 lakh crore to the system. We have also decided to widen the monetary policy rate corridor. Let me elaborate. In view of persistent excess liquidity, it has been decided to widen the existing policy rate corridor from 50 basis points to 65 basis points. Under the new corridor, the reverse repo rate under the liquidity adjustment facility would be 40 basis points lower than the policy repo rate as against the existing 25 basis points. The marginal standing facility rate would of course continue to be 25 basis points above the policy rate. The second set of measures relate to regulation and supervision, that is basically certain regulatory measures. Alongside liquidity measures, it's very important that steps are taken to mitigate the burden of debt servicing brought about by disruptions on account of the COVID-19 pandemic. Such steps in turn will go a long way to prevent the transmission of financial stress to the real economy and ensure the continuity of viable businesses and provide relief to borrowers in these extraordinary times. Under these measures relating to regulation, the first measure is with regard to moratorium on term loans. All commercial banks, including regional rural banks, small finance banks and local area banks, cooperative banks, all India financial institutions and NBFCs, including housing finance companies and microfinance institutions, that is all lending institutions basically in the system, are being permitted to allow a 3-month moratorium. I repeat, all the lending institutions are being permitted to allow a moratorium of 3 months on payment of installments in respect of all term loans outstanding as on 1st March 2020. The second measure under this relates to deferment of interest on working capital facilities. In respect of working capital facilities sanctioned in the form of cash credit, overdraft, lending institutions are being permitted to allow a deferment of 3 months on payment of interest in respect of all such facilities outstanding as on 1st March 2020. The accumulated interest for the period will be paid after the expiry of the deferment period. The moratorium on term loans and the deferring of interest payments on working capital will not result in asset classification downgrade. The next announcement relates to easing of working capital financing. In respect of working capital facilities sanctioned in the form of cash credit, overdraft, lending institutions are allowed to recalculate drawing power by reducing margins and or by reassessing the working capital cycle for the borrowers. Such changes, I repeat, such changes will not result in asset classification downgrade. The moratorium on term loans, the deferring of interest payments on working capital and the easing of working capital financing, which I just announced, will not qualify as a default for the purpose of supervisory reporting and reporting to credit information companies by the lending institutions. Hence, there will be no adverse impact on the credit history of the beneficiaries. The next announcement relates to deferment of implementation of net stable funding ratio, NSFR. The net stable funding ratio, which reduces funding risk by requiring the banks to fund their activities with sufficiently stable sources of funding over a time horizon of 1 year in order to mitigate the risk of future funding stress, was required to be introduced by the banks in India from 1st April 2020. It has now been decided to defer the implementation of NSFR by 6 months to 1st October 2020. Deferment of last tranche of capital conservation buffer, that is the next announcement. The capital conservation buffer CCB is designed to ensure that banks build up capital buffers during normal times, that is outside periods of stress, which can be drawn down as losses are incurred during a stress period. Considering the potential stress on account of COVID-19, it has been decided to further defer the implementation of the last tranche of 0.625% of CCB from March 31st, 2020 to September 30th, 2020. With regard to financial markets, that is the third part of the announcement, we are announcing one measure, and this measure basically assumes importance in the context of the increased volatility of the Indian rupee caused by the impact of COVID-19 on currency markets. And this relates to permitting banks to deal in offshore non-deliverable rupee derivative markets, that is basically offshore rupee NDF markets. The offshore Indian rupee derivative market, that is the non-deliverable forward market, that is NDF market, has been growing rapidly in recent times. At present, Indian banks are not permitted to participate in this market, although the benefits of their participation in NDF market have been widely recognized. The time is opposite to improve efficiency of price discovery. Accordingly, banks in India which operate International Financial Service Center IFSC banking units, that is IBUs, are being allowed to participate in NDF market with effect from June 1st, 2020. Since last MPC meeting of, and let me now come to the concluding part, and this is very important because there are, I have attempted to give some forward guidance, so I request your patience. Since the last MPC meeting of February 2020, the Reserve Bank has injected liquidity of 2,80,000 crores, 2.8 lakh crore through various instruments, which is equivalent to 1.4% of our GDP. Together with the liquidity measures announced today, RBI's liquidity injection works out to about 3.2% of the GDP. The RBI, I repeat, the RBI will continue to remain vigilant and take whatever steps are necessary to mitigate the economic impact of COVID-19 and preserve financial stability in the country. As I had stated earlier, all instruments, I repeat, all instruments, conventional and unconventional, are on the table. Before I conclude, let me reiterate that the Indian banking system is safe and sound. In recent past, COVID-19 related volatility in stock market has impacted share prices of banks as well, resulting in some panic withdrawal of deposits from a few private sector banks. It would be fallacious to link share prices to safety of deposits. As I have mentioned in my earlier interaction with the media, depositors of commercial banks, including private sector banks, need not worry on the safety of their funds. I would therefore urge members of public as well as various public authorities who have deposits in private sector banks not to resort to any panic withdrawal of their funds. Their funds are safe. In conclusion, let me say that in spite of the very challenging environment, I remain optimistic. It is worthwhile bearing in mind that the macroeconomic fundamentals of the Indian economy are sound and in fact stronger than what they were in the aftermath of the global financial crisis of 2008-9. The fiscal deficit and the current account deficit are now much lower. Inflation conditions are relatively benign, and financial volatility measured by change in stock prices from recent peaks and average daily change in exchange rate of the rupee is distinctly lower. COVID-19 is upon us, but this too shall pass. We need to remain careful, take all precautionary measures. I leave you with this comforting thought: stay clean, stay safe, and go digital. Thank you very much.